Either they start off with too little money for the risk and volatility they're willing to accept, or they come in with too much money for their risk threshold. Basically throwing money out there and having no clue what they're doing. And basically underestimating or overestimating their capabilities at trading the markets with this little bit of money or too much money. Unfortunately, futures has a lot of bad reputations in a positive way. Richard Dennis, one of the most well-known futures traders in America, developed the turtle trader method of futures trading. And there's stories of him, which have been documented, of starting off with $400 and over the course of 15 to 17 years, building a portfolio for himself of $200 million, solely beginning with that $400. Now, you hear a statement like that, and you have to look at it as an exception to the rule, not an actual event that can happen. But you also have people like Larry Williams, which is also a well-known educator in trading. Great, I've spoken with him before, great guy, and has a lot of great information. But at one time, he was involved in a trading contest and put $10,000 in, and at the end of 1 year, brought in $1 million. He later went on to teach his techniques to his daughter, and she was able to put $10,000 in and brought in, I think, $136,000 in another contest. So you hear these stories of people making huge amounts of money trading futures, and so many people come in and expect that if they put in $10,000, they'll be able to make $1 million, or if they put in $400 or $500, they'll be like Richard Dennis and make $200 million, in which these things are not the norm. So properly funding your account based on your risk level and the amount of capital you have is important, and also just having realistic goals for the amount of capital that you put in. So properly fund your account. One of the terrible statistics that I've heard came out from the National Futures Association not too long ago. And they talked about how people who are new to futures fund their individual discount accounts with a total amount of $16,000. Now, people who are familiar with trading and are used to how futures operate have no problem with setting up an account of this amount. But most people who come in with a large account of $16,000 end up blowing out their entire account because they don't understand how leverage works. But what was even more disturbing about the statistic is that people who invest with full-service brokers invest the exact same amount that they invested in the 70s, which is approximately $5,000. So actually these numbers are reversed. With inflation having increased approximately 3 times since the 70s, people should be investing with a full-service broker $10,000 to $15,000 as opposed to investing in a discount account $10,000 to $15,000. You see, as full-service brokers, and good ones, and I know not all full-service brokers are good, you have an opportunity to learn the rudimentaries of futures investing with someone to bounce ideas off of and to work you through the process of understanding orders and understanding some of the definitions we discussed here and many more that exist in futures. So by investing more with your full-service broker, you have an opportunity to learn more. So be careful when setting up your account and putting too much money to trade on your own. 4, choosing cost over quality. In futures trading, and I believe in the stockbroking world as well, and the brokerage industry in total, we have a problem with the word commission. Commission is usually considered execution of a trade by many investors. Unfortunately, execution of a trade is actually one aspect of the commission process. And so when new investors decide to trade on commission only, they're doing themselves a disservice from all the various other services that they can receive. Everyone knows that now with electronic formats happening, execution should really cost no more than a few dollars per trade. And in our market, commission is charged on a round turn basis. So maybe $4 or $5 in and $4 or $5 out. So you have to decide what services you need as an investor that can help you in your overall investing experience. So full-service brokers offer 5 core functions in addition to execution. And I believe that most investors, without finding the proper education either by going to a company like pristine.com and getting these types of videos, or working directly with a broker to learn how trading happens, they're actually lengthening their learning curve and doing themselves and their money a true disservice by not finding the education and the help they need. And that's what full-service brokers can provide. Now, full-service brokers form 6 functions, one of which is execution. More importantly, for new traders trying to understand the massive information coming into the futures market, futures brokers allow for trade development. They have access to all of the information, up-to-date information on when the reports are coming out for soybean and the S&P. They also have a way to interpret this information with all of the other factors that are going on into the market, such as open interest, which is very unique to futures and options, volatility, and all these other factors. And so they have an opportunity to give you or analyze trades for you that are appropriate for your risk level and your investment experience. They also are trade monitors. Many people who complain about commissions miss the point that when you pay a commission, you're actually having someone watch your trades for you, so you don't have to sit there all day. One example is in futures contract or in full-service brokering, commissions can range anywhere from $100 to $200. So let's take a median number of $150. If you were to pay a $150 commission for one round-turn contract, which is leveraging $30,000, like our gold example, and the broker sat and watched your trade for a total of 20 hours, which is very easy during the course of a week, you're actually paying that broker $7.50 an hour to watch your trade. Now, many traders would see that and see logically, well, yeah, it's $7.50. It's practically minimum wage to have someone watch and monitor my investments. There's no way you can lose in that scenario. But if you are an active trader and you have an opportunity to sit and monitor and watch it, you have to look at it from the cost-benefit basis. That are you worth more than $7.50 an hour in just sitting and watching trades develop? So that's one service they follow. Another service that full-service brokers do is post-trade evaluation. This is very important, especially in the system that we have here at Liverpool Derivatives Group, where post-trade evaluation is practically everything. What we have done is we've created a tool called the Futures Trading Journal. And the Trading Journal allows a investor to write down what the trade was like when they entered the trade and what their feelings were when they entered it, and more importantly, how they operated and what they were thinking when they exited the trade. Now, the Futures Trading Journal does two things. First, it allows you to remove or eliminate some of the self-worries of fear and greed. You're able to have a third party, your trading journal, document your trades. And the second thing it does is it objectifies your trading. It allows you to look at your trading in a longer view, that this is just one of many trades. So it's a tool that we use, and we're very proud at our company, along with two other tools that we'll discuss later. Fifth, account auditing. Account auditing is very important. Even though futures trading and electronic trading is very effective now, mistakes still happen. Whether you've got a bad fill unnecessarily based on when the orders were entered, whether the floor hasn't filled your order, a lot of mistakes can occur. And so you're able to have someone who looks through your account and makes sure that the amounts of entry and exit are the proper amounts. You also have someone who will look and make sure the commissions and the NFA fees are not excessive, as well as making sure that the commodities that were traded were the actual commodities that you wanted to trade, and there were no discrepancies, such as when you put in an order for one contract, you were locked in for two.